Hello and welcome to episode 10 of the Consumer Credit Matters podcast. I'm your host, William Black. My very special guest this time around is Altin Kadareja. Altin is the CEO and co-founder of a company called Cardo AI. Cardo is a technology solutions company offering tech-forward solutions to the consumer credit ecosphere. Call them the ABS issuers of the world, or trustees, servicers, asset owners, fintech lenders. All of these companies have one thing in common, at least, and that is that they deal with vast and disparate amounts of data, and they need a way to kind of get their arms around that, manage, store, analyze, and use that data to forecast and make better credit decisions. And that's what Altin's company, Cardo, does. And Altin very generously describes in fairly granular detail just how Cardo adds value for its target customers. We go layer by layer, ending in a case study that goes into quite a bit of detail along those lines. We do touch on some topical items as well, as one does. AI, of course, it's in the name, and we talk about how Cardo uses AI specifically. And we also talk about the opportunities and challenges that are in the headlines now, like private credit, and just how that space is expanding and growing and providing, again, an opportunity for Cardo and companies like Cardo who are in this space. So a great, again, instructive, granular conversation about this important dimension of consumer credit. I hope you find it as interesting as I did. And again, as always, thank you for joining Consumer Credit Matters podcast. Enjoy. Hello, Altin Kadareja. Thanks for joining me.
Pleasure to be here, man.
Yeah. I've been looking forward to this podcast really because you and I had a conversation a couple months ago, and you were educating me on what your company does and what your company's ambitions are coming over to the U.S. And I just think it's going to make for a really interesting conversation. It has all the kind of great ingredients for a great conversation. We've got, entrepreneurial spirit, breaking into a marketplace, the U.S. in this case, focused on structured finance and servicing platforms. AI, of course, the perennial kind of headline maker. All those ingredients, I think, are going to enter into our conversation today. But before we get too far down that path, Altin, I wanted to ask you, maybe you can give the audience, who I don't think most of the U.S. audience knows that much about you and Cardo AI, but maybe you can give us a little bit about you first and kind of your origin story and how you started or got to this place where you are with starting the Cardo AI business.
Absolutely, William. Thanks a lot for the invitation, and I've been looking forward to this podcast and interview for a long time as well. So a little bit on myself. I was born in Albania, Tirana. It's a country in the Central Eastern Europe. And then I went to study in Milan, where I started the company. After the studies, I did business administration and economics of innovation, new technologies in one very good university here. And then I entered into the banking and asset management world. I've done a lot of experiences around commercial banks, insurance companies, asset managers. The last work was at BlackRock. I was part of a team called FMA. And within that role, I was in charge of helping clients to understand better credit portfolios, collateral values, their quality, and come up with strategies on how to acquire those portfolios. And as you can imagine, back then this was all done in spreadsheets and Word documents. And just to summarize that, more than 80% of my time and my team's time was spent in trying to retrieve the data from different formats, cleaning them, standardizing them, and finally calculating different analytics that were needed by our clients. So imagine to have a credit portfolio of 50,000 rows with all loan information, and then on the vertical side, 300 columns. So imagine that every time we were changing one data point, it was big hopes that Excel didn't break up. And when it broke up, then how much time it would take to recover the previous version of this work that we have done for days and days.
Right.
So don't get me wrong, right? I mean, I don't mean like spreadsheets are the worst tool ever. They are a great tool for some specific activities, and I still use them myself. But it's not definitely meant to manage big data portfolio analysis and big data, credit positions. So basically, William, what I did, I decided to create a solution for this. So to help me, myself, and my team not waste any more time in manual activities and rather dedicate my time towards making better decisions, but also creating, let's say, innovative solutions to help my clients. So that's how the idea of Cardo AI started. This was 6 years ago in Milan. Then we grown our team to 120 people across different locations. We opened our London office, we opened our Tirana office for the tech side and also Kosovo. And now we opened our New York office. So we are ready to do business in the US. We already have a couple of clients signing up, starting to use our technology. So we are very excited to be in the US.
I like to ask entrepreneurs this question. It seems silly, but I think there's sometimes something in the name. What was the AI I get? What was the genesis of Cardo AI?
Absolutely. So I was visiting Jerusalem. I think it was 6 years ago while I was starting the company. And one of the Italian guys that I hired to explain me the history of the city was explaining how the old Roman architects were building the Roman cities while they were occupying every new city and every new country. And all the new cities were being built across two main streets. So one was connecting the north and the south, called Cardo, and then the other one was connecting the east and the west, called Decumano. And the Cardo, so the main street where all the activity was happening, resonated a lot with what we wanted to do. So our big mission into this company is to try to put every economic activity around the asset-based credit market and make people abilities to interact with this market much better and more faster and quicker with an intelligent technology that we have developed. So that's where it comes from.
I love it. I love it. That's a great story. So maybe a little bit more about Cardo AI. I guess, you're facilitating data management. So you're very tech forward. You're working with big data from other companies. Maybe you can drill down another layer. I think that's what we're going to end up doing, layer by layer here, in terms of, say, the addressable market or the segment of the capital markets that you're targeting.
Absolutely. So the market that we are targeting, or the place where we play mostly, is the asset-based credit market. It's, as you might know, it's facing extraordinary growth. Apollo himself, they are projected to have a 20 trillion market from what today is considered a 2 trillion market, so 10 times more. And this growth seems a lot, right? But it's true. And
here, sorry, just to clarify, asset-based lending, you're referring to, very broadly speaking, asset-based lending. So including, of course, structured finance, right? I mean, this is the market. Yeah.
So when we talk about asset-based credit market, we talk about structured credit, we talk about credit facilities, forward flows, everything that is around the ABL industry. So also private credit and direct lending. Sometimes also private credit CLOs are included in this market. So every kind of fund structure that has underlying assets to protect that kind of structure is called what we consider to be an asset-based credit market.
Gotcha.
And just to continue on that, Will, if you'd allow me to tell you why we think that there is this big growth and then there is this big shift towards, a very significant growth. So I would say there are like 3 or 4 main tailwinds that the market is seeing. So after 2008, the financial crisis, there has been a lot of gradual withdrawal of banks from the credit market because from the one side, regulators doesn't have increased the cost of this kind of credit activities throughout the regulatory requirements. And that has created a lot of opportunities for private lenders to get into the market and
Yep.
finance these areas.
Direct lending.
Correct. And then also the appetite from institutional investors, right? So we have seen a very gradual increase up to 2023 when we had this big increase on interest rates. And now it's going down again, the interest rates with the US cutting with 50 bips in the last months. And now it's growing again. So institutional investors are finding their way towards the private credit and alternative credit markets. And they see that actually it's not only a diversification strategy, but it's an attractive risk-adjusted return strategy. So a lot of portfolios that we have seen to use our technology compared to the traditional fixed income investments have done much better.
Yeah, I just want to ask you a little bit about that because you mentioned a couple of things. So there's obviously the huge growth in private credit market over that over the last few years actually, just starting with say maybe pre-COVID, and the hike in rates in the U.S. certainly precipitated some of that. So, is your target market primarily that market, the private credit market, or do you also service the securitizers of the world, for example?
Yeah, so that's a great question, William.
I know there's overlap between the two, by the way. I just want to know kind of where you're headed.
So our core is the asset-based credit. So it is not direct lending, the typical direct lending that we would do, because the direct lending, we feel it's a much simpler market to solve in terms of technology. But when it comes to underlying collateral of credit structure, that's where the complexity comes in. And also when that structure is being allocated in different fund allocations or portfolios, that's an additional layer of complexity. And when that complexity then is being required from investors on the other side, then it becomes yet a third level of complexity. So we play on the asset-based credit market.
Okay. So I don't want to leave private credit too quickly because, as you mentioned, it's a big market. It's been growing very quickly. It's certainly grabbing the headlines here in the U.S. and I suspect around the world, or certainly in Europe, as this now $1.7 trillion market that's expected to grow another order of magnitude perhaps over the next several years. One of the questions that I think remains open, and I'd like to get your thoughts on this, or whether it even matters to Cardo AI, is, with the rates coming back down, do you see that as a headwind or tailwind, or just don't know, to private credit?
It's definitely a tailwind. So the interest rate coming down, because you have to think about what are the drivers of the market. The biggest driver are the investors, right? So we have institutional investors pushing the GPs towards what are the main needs of this market. And whenever the interest rates are down, you need other alternatives to produce more returns. And also to diversify. But I would say that the big important factor on the private credit market has been, will the default rates or will the losses keep up or go up or down depending on how you see that in a high interest rate environment, which is what we passed by and what we're going to see probably in a few years. And I have to say that if you look at the default rate or losses, they are even lower than the high yield market or leveraged loan market.
That's right.
For the private credit. So that has been yet another confirmation to all the people that was doubting this market and saying, yes, but you have never stress test the market into a stress situation or a stress macroeconomic environment. And this has proven to be already a very good quality on how the managers have managed to upstand these conditions. So with the rates going down, I see a very big increase into this market because first we have passed what was supposed to be a very difficult situation or a downturn scenario, considering also the COVID situation. So almost two downturns. And with the interest rate going down, probably we'll have much more institutional investors to demand for these kind of strategies to be allocated into their portfolios. But there is the last element that I want to stress, William, which is the private credit market is not just this artificial animal that came from somewhere, right? It came also from the demand that borrowers themselves have, because the borrowers need speed, need flexibility.
Absolutely. Yep. Yep.
And traditional banks, unfortunately, are not yet there. So either they innovate and they try to change things, or the GPs are very flexible and very fast to underwrite credit because of their aligned missions, but also because of their aligned structure. Because GPs have not the problem that banks have in terms of asset and liability mismatch of the maturities. Banks have long assets and short liabilities, right? The GPs are all aligned because they have long liabilities, long assets. So in this sense, another SVB would not be present just because the structure is different. And just to share with you a case in the market, we saw Apollo and Citi doing a deal just weeks ago into this market specifically. So targeting private credit deals with Apollo putting their liabilities and Citi putting their origination power.
Right.
Now, you would say, why would Citi, with all the resources that they have, go for it? Just because their structure is different, and just because the regulators want banks to become free of any systemic risk.
And I just read an article not that long ago, just last week, I think it was, talking about the fact that some of these firms, these private credit firms, now are at least filing with the SEC to launch ETFs oriented towards the retail investor.
Yeah.
So, that's a sign of growth, certainly, and tapping new markets for capital to feed some of that growth, as I see it anyway. And it's just an interesting new frontier, I think, for offering, if it gets, once it gets past the regulators, for offering retail investors some access point to what has been the exclusive domain of institutional investors. And there's a lot more we could talk about just in terms of that venture, or that part of the development of private credit. But I just want to get back. So Cardo AI basically saw an opportunity with the very rapid growth in private credit. Because it was growing so rapidly, there was a clear need for expertise in managing the data, because again, this is just mushroomed in terms of growth. And the private credit firms that have been good at managing those assets basically are looking outside of their own firms for help in managing and offshoring, what have you, this particular set of skills to manage the data. Do I have that narrative right?
Yeah, absolutely, William. And just to touch a bit on the ETF story that you mentioned, I think that is a clear indication of the maturity of the market. I feel like when you have those kind of push in the market, obviously you need to have a much more faster system, but also a much more secure system to calculate, for example, the valuation of your positions.
Yep.
Because imagine the retail investors, that's why the creation of the ETFs, you can have much more quicker redemptions, right? You can have faster people that want to go out, other people that want to go in. And it's almost like creating a private credit liquid market, right? So
Yep.
the paradox of not calling it anymore a private credit, but a liquid credit that at the end of the day becomes available also for the retail investors, which I think it's a great thing. We have been looking for this for a long time, and hopefully we will make it happen.
I saw I did peruse, I'll put it that way, the filing that I think it was State Street's ETF that they filed recently. They proposed to solve that, call it liquidity problem, with another third party who's going to basically stand in the ready to purchase, to make any purchases necessary. They're basically trying to solve for this liquidity problem that you're talking about, offering a market value for any redemptions.
Yeah.
That's something, I imagine is very tricky, but probably is something that you have an opinion about, maybe, and some expertise
Absolutely,
in.
William, and that's where the technology play comes into help, right? Because
Right.
imagine now, from the one side, you have this third party that is offering liquidity to the fund. The fund manager needs to subscribe, for example, a new loan that they have been negotiating for 2 weeks or 3 weeks, and then suddenly 10% of the fund is being is asking for redemption because for some reason people have needs and they need to require back the money, right? At
Right.
that moment, imagine at that single moment, you have at least three actors that need to act on a certain requirement. And that specific time, you need to have a valuation of the positions. You need to have a request on a fund finance basis, which is what the third party would offer to
Right.
support the fund on. And then you have to have an approval and a negotiation as well. All of this almost real time. So you can imagine how difficult it is to do it without technology. And that's where we play a big role, because we would sit in the middle of where the market needs the information. So
Right.
from the one side, take the requirements, on the other side, collect all the data that are needed, already onboarded into our technology. And on the other side, calculate and negotiate, support the two parties to negotiate the fund finance business. And all of that are layers of complexity that it makes it very, very hard and very difficult for you to solve without a proper tech.
So is this function that you just described so well an aspirational role that you have, obviously, for the US as you break into this market, but is it something that is still aspirational in Europe, or is it something that you're already doing and have been doing in that market for
Yeah,
their
yeah.
purposes?
So we have been doing this in the UK market specifically, and we see a lot of need from the US market in exactly what you mentioned. Now, we're not talking about the redemptions from the ETF, because the ETF is just being born, but the
Right.
redemptions from other investors, which the structure and the workflow looks the same. Our hope for the US market is mostly coming from the buy side. So, exactly the GPs that need to manage the quality of their portfolio, get speed into new investments, so allocate money faster and not lose on opportunities for things that they are seeing. But also, and most importantly, I would say, managing the structure and the complexity that comes with the liability structure or the fund structure that I mentioned before. So, these three things have been the biggest need that we have seen in the market. And lastly, I would say the GPs in the US are a bit more sophisticated, so they have more strategies and they sit on a lot of data and ideas that are living into silos. So what we want to bring to the market is a platform that can aggregate these strategies and these logics and help the GPs scale faster, but also leverage all the data and everything that they have seen and done before, which is a novelty. And let me spend one more minute on this, because we have spent a lot of months to do it right. So when you use our technology, William, you don't just start from the moment that you install our technology and you start using it, but we would go back to the history of all your portfolios and reconstruct all that history back. So it's almost like you have used the technology since day one. Imagine, for example, a KKR or an Apollo or an Ares that started their funds 10 or 15 years ago. All that history is lost if you keep on having them in databases or in Excel, that you cannot really use that knowledge. But if you use Cardo, we would go back in time, restructure the history, prepare the data, clean them, standardize them, so yourself or our team could build models and algorithms on top of that to educate and support the future decisions. And I think this is something incredible that I haven't seen done before, not in the US, but not also in Europe and in the UK.
Right. So it feels like it's always been a part of the infrastructure
Correct.
from the moment you flip the switch over to Cardo. That's the idea. And I can imagine you're making it sound very simple and easy, but I've spoken with enough folks in this line of work to know that call it normalization, onboarding, whatever you want to call it,
Yeah.
is a very heavy lift, because you're converting syntax, you're just there's an error everywhere you turn. I think
Yeah.
the
Yeah.
syntax is wrong and it throws everything off. You're trying to make two different systems talk to one another. Sometimes it's a lot more than two systems, right? So that's
And
a heavy
sometimes
lift.
there are also a lot of external systems, right? Because we
Right.
are talking about a credit ecosystem that is made of issuers, originators, it's made of servicers, so fund administrators, trustees, rating agencies, you name them.
Yep.
And then it's made of investors, right? So you have at least 7 to 8 different external systems all converging into one database. Let's call it like that for the sake of easiness. And then that will communicate also with the internal system of the GP to make sense of what we need to calculate and everything we need to do.
Got it. So let's go one more layer down, and I think what might help solidify a little bit more what Cardo is doing is that maybe you can offer a case study on an anonymized basis, if that makes sense. But
Yeah.
basically, a customer of your choice comes to you with a problem to solve. Maybe a granular kind of example like that will really kind of
Yeah.
solidify what Cardo is bringing to the table in terms of value add.
Absolutely, William. Thanks for getting me there. So one case, for example, is one of our clients in the UK. I'll just take that for the sake of simplicity. So they started to use the system when they were at 700, 800 million of investments, of assets under management. And they came to us and said, hey guys, we have a big problem due to a lot of data coming from different systems and different formats. We cannot think around this data in a fast way, so we need to either invest in new opportunities or understand our daily performance, so structuring and shadow NAV system. And we cannot report back to the investors when they ask us because they would come up with ad hoc requirements. They would, demand to go deeper into the portfolios. And we also invest in many, many countries. So we have FX hedging situation and everything is running in spreadsheets. The problem is that they cannot scale more. So they had LPs coming to them and saying, I want to invest more with you guys, but I cannot manage them. So, or I need to scale by hiring 2 times, 3 times more people. And I don't want to do that. So the challenge was clear. We needed to automatize the data onboarding, data treatment, data cleaning, the data calculation, and then feed those data calculation into an engine that supports the risk operations and investment professionals to do everything they do on a daily basis. So with us on the process, in 2.5 years almost, we integrated, I think, around 115 different originators in the same technology, all with different data structures in different countries, across 22, 23 different funds structures. And we scaled this company from 700 million to 4.5 billion that they are today. And they have increased their operations team with 15 to 20%. So we have helped them reduce a lot the costs per unit, per dollar, per euro in this case, and also help them use that knowledge because this is key, right? So, for example, they had an additional need whereby they said, Cardo is great. So we have all the data clean, all the data treated correctly. We have a lot of features that our teams are using. But you know what? We need to have our data science team to build models on top of those data. And we said, that's awesome because that's exactly where we want our clients to be, not blocked by us or not locked in as we used to be called in how the technology software providers are usually being called. But we want to innovate with our clients. So what we did is that we gave this middle layer infrastructure access whereby their data science team could get into, take all the data they need, run all their models. We help them also run a machine learning as a service model. So they could keep all the information intelligence within their processes, but in the same time have the data science team innovate alongside our infrastructure. And that has been a great success, I think, and I'm looking forward to see if I can innovate for the clients in different angles.
So what I'm hearing is The initial problem was a company that was growing with disparate kind of tracking and monitoring and recording of its activities, its financial activities. It needed a way to tie that together. But you also are providing something else. I heard. Correct me if I'm wrong. Is that management reporting, right? So you have the ability. Management would have the ability from whatever silo they operate in, from whatever perspective they have from within the firm, whatever desk they're running, whatever portfolio they're managing, for example, they can look at their slice of the activity. And then I think what I also heard from you is that your system is, or your solution is flexible enough to allow them to then build on top of that or integrate within that to layer on their own proprietary analytics or analytic engines and integrate with that flow of information. Is that do I have that right?
You said it better than me, William. So I will quote all the things that you summarized in the best way. So lastly, on the reporting, so we have built this tool called Dynamic Report. It's built by us, whereby every type or characteristics of reports that you want to build, being it vertically or horizontally or in different dimensions, you could do that on your own without knowing how to code, right? That's the other key challenge we had, because not lots of GPs have developers within their organization. So the smaller ones with teams of 10, 50 people, they will need to be focused on the originating deals and managing portfolios rather than writing the code. Whereas the bigger ones sometimes have a lot of engineers that can leverage our system and can write code on top of it. But the idea is to have also for the analysts that have never wanted to write code to be able to design a report and within that easily customize the views that they want and deliver that report in no time. And instead of waiting for the data analyst to come back in 3 or 4 days, which is what typically happens, you'd have the report up and running in 1 hour or less. So that's very flexible, and it's amazing to see what kind of reports different clients are developing. And again, we don't know what the future holds, William. That's the key. We cannot pretend to know everything and to code it into a software. All we can do is provide all the tools, but also the openness to those tools so that clients themselves innovate with it.
Right. Okay. I do want to eventually get to your foray into the U.S. market. Before we get there, I wanted to at least close off the AI. You mentioned machine learning, and obviously AI is in the name. Maybe you can tell us a little bit about how you're integrating that technology in your offering.
Yeah, absolutely. So we see AI as an embedded feature, so not something that we would sell outside ourselves, like a separate offering or a consulting offering. So the artificial intelligence we use is embedded throughout the whole process. It starts from the data extraction to generating different insights to forecasting and to propose different portfolio optimization strategies. So I would say if you take the 100% of AI we have now, 70% of that would be predictive and forecasting AI, and 30% would be more into trying to extract data, make sense of unstructured data, so more towards the LLM world. So,
go ahead.
Yeah, go on.
No, I was just going to ask it. Can you give an example? Because, I mean, you can't have a conversation in finance nowadays without having a conversation around AI. And everybody is using it. Everybody sees its potential.
Yeah.
I think my view is that there's a lot of investment going on. And in these early days, there's some low-hanging fruit around operations that is adding value, efficiency gains. You can kind of see maybe in the next couple of years, or maybe even shorter than that, some operational functions being, again, either eliminated or greatly reduced due to AI. But where AI doesn't seem to be ready for prime time is in any part of the industry where accuracy is paramount, because it's still producing results that need to be checked by humans, right?
Yeah.
And verified in some way. So I just want to know exactly how the AI is. You mentioned that it's not a standalone kind of proprietary function
Yeah.
at this point. So are
So
you using like off the shelf, I don't know, Chat GPT 4.0 to help with your forecasting? I'm sure
yeah.
that's not the case, but maybe you can just be a little more granular about how AI is integrated.
Absolutely,
Yeah.
absolutely. Now, I see from your question, William, that it's something that we usually get when we talk to clients. It's because our association of AI is LLMs, right? So ChatGPT is Gemini and all of what we know so far. Now, there is a big branch of artificial intelligence which is related to machine learning, and it's predicting or forecasting a specific analytic or data that you need for taking a decision. And that case, for example, is the loss prediction, right? So when we talk about credit investment, one of the most important things that we need to understand is what is the probability to lose my money into this position within this debtor or within this structure. And that takes a lot of nuances around probability default models, loss given default models, prepayment likelihood, ROI, pricing optimization, and a lot of small models that contribute together into a bigger one to decide and to help the clients, is this a good investment? Am I paying the right kind of price for the risk that I'm taking, considering what I know from this market? But most importantly, introducing alternative data, William. So we think that a lot of buying behaviors are impacted from lots of activities all around ourselves. So consumers, for example, that are being influenced from one factor or from another factor, if we can be able to extract those data from alternative databases and embed them into our models, at least on the first indications that we have, is that we are able to improve the model forecast with 10 or 15%.
Right.
So, including alternative data in the US for consumer loans, for example, our previous accuracy was at around 75, 76%. Now we are at 80, 85, or 90% just because of the inclusion of alternative data. The LLM we use a lot, for example, to not really leave the algorithm, as you correctly said, and extract data from documents. But as you might know, our market is very heavily designed by documents, so legal contracts, agreements, addendums, amendments, a lot of stuff that happened throughout the whole lifetime of a credit position. Now, you can imagine all those docs sitting somewhere that, some people saw it in the beginning and nobody else checks them after 1 year or 2 years. People change, teams change, and all of the information is sitting there. Now, what we do with the LLMs, and this is an open source that we take from one of the biggest LLMs out there, we have then improve that with our use case, and we have trained them on our use case, is taking all these contracts, training the algorithm, and almost like interacting with this algorithm. So asking questions and trying to get the answers from the document itself, limiting the quality of the answer, obviously, and not try and avoiding the hallucination, which is a big problem that LLMs have now. But if the model is small enough and trained on a very specific task, then it becomes almost like a specific agent for what you want to do. And that, for example, we have seen has improved our work with 35 to 40%. So internal work, right? Tomorrow you become our client, you give us all the documents. It takes us, for example, 40% less time to onboard those data within the technology.
So let me ask if this is an example, like coding the waterfall in a prospectus.
Yeah.
I mean, is that a good example of how AI can maybe not, go all the way and cross the finish line, but get you very close to the finish line, where then a human comes in and does some quality control kind of activity.
That's a great example. I wouldn't say very close to the finish line, as I mentioned, is at 40% now, but. Okay. Done at scale, it's an amazing improvement for us. So,
I bet.
And then we see to increase that to get to up to 75%. We hope to do that by the mid of next year, because the speed to which these large language models are improving, it's incredible. So I've never seen in my life, I'm quite young obviously, but I've never seen in my life anything that is growing and improving so rapidly. So
that you mentioned two uses that I put them in these buckets. You have I would say the one where you're onboarding and helping you code, I use the example of waterfalls, but read documents, that is, I would call it an operational efficiency use of the LLMs. Okay, that's very straightforward. The other use that you mentioned was more in the forecasting.
Yeah.
Now, here it gets interesting to me is if you're using it for forecasting and you're using, as you say, alternative data, which is much more open-ended because you don't know what alternative data matters. You're asking the LLM to seek out, find meaningful signal with all the noise that's out there. I'll put it that way. And helping forecast what exactly is it? Performance? Is it shaping the underwriting algorithms? And if it's the latter, then how do you navigate some of the regulatory concerns around using alternative data for this purpose?
So that's a great question, William. Now, what we do is that we predict and forecast, for example, the probability of default, right? As simple as that.
Okay.
Using machine learning models, because we believe and we have seen that they perform much better when we have a big database, and consumer loans, for example, in the US are big database, or auto loans, another example. And we have historical data, so 10, 15 years of data, which we apply all our logics. We never ask the LLM to tell us anything. We apply a lot of databases that we buy or alternative data that we scrape or extract from different sources. And we take those data and we test towards what we want to predict and what we want to forecast. And as I mentioned...
So, sorry, that's more like machine learning. I'm thinking of it. It's more like machine learning. It's more internal. It's less... it can be very ambitious, especially at scale, but you're talking about kind of like Markov modeling on steroids kind of thing.
Absolutely.
Yeah, okay.
Distribute, decision trees, anything that is within the machine learning cluster of modeling, because we know it's a middle ground between unsupervised and supervised methodologies, which we can still control and can direct. And by directing that, we know where we want to go. And in that case, we have seen an improvement, as I mentioned, of 10 or 15% on the accuracy, which is very, very big, because
it is.
Think about it. It's imagine that you have an exposure of 1 billion towards the consumer loans because you have constructed different portfolios and all of it. Imagine that you would be able to predict losses on a 10 or 50% better. So either you structure the new portfolios in a better way, or you know how to price better the current ones that you are going to negotiate or you are going to amend in the future. So it's an additional insight that you didn't have so far because you didn't have the power of the data and the power of the technology in this case. So that's how we feel our clients are using that. And the more we go forward, William, we would embed new models, right? And this way of thinking of AI around agents using the LLMs, but also the machine learning, we feel it's a very good combination of where we want to get with these technologies, because we would have different agents acting according to their needs, which one guy could be the risk guy, the other guy could be the pricing guy, the other guy could be the negotiator guy, all with different objectives and all trained to do different activities, and then we'll see who wins at the end.
Okay, so I think we covered AI. I want to now maybe bring us to your ambitions to enter into the U.S. market, and I understand you already have some inroads there.
Yeah.
You mentioned you already have some customers, and I do think it's interesting because it's a different market, obviously very, very big, much larger. I think addressable market in the U.S. I think it's safe to say tens of trillions of dollars for the general addressable market for a company like yours. The private credit market, we talked a little bit about that, is fairly concentrated. A half a dozen or so firms dominate that landscape, and some of them, including the one I guess that you worked at, you mentioned you worked at BlackRock, have their own competitor solutions to what Cardo offers right now. So maybe you can talk a little bit about the competitive landscape as you see it, the opportunity, the addressable market for Cardo as you come into this market?
Absolutely. Thanks for this question, William. And I would start from one thing that one of my, because you mentioned BlackRock, one of my previous bosses in BlackRock was, when he came to Milan, right, he was always saying, if you can make it in Milan in terms of innovation, you can make it everywhere. Because we are so much against it and so much pushing towards, the classical, traditional, no change kind of stuff, instead of when I get to the US, and I've been traveling to New York for the past 8 to 9 months to open up the market, it's like a dream come true for me, right? Because it's really resonates with the way I think or the way we have built the company. And now finally we have the opportunity to prove what we have done in the 6 years in Europe and the UK. And from a very, very tough market, because here we have fragmented ways of thinking, fragmented investments, different languages, different currencies, different ways of doing business. Whereas in the US, it is all around this, but it's much more standardized. So people think the same, they have the same currency, one problem less. They want to scale faster and they want to go faster and compete very faster with the others. And this is something that technology can allow them to do. They want to enter into a new strategy, but they want the knowledge with it. We can help with that. So there are a lot of things that we have been struggling in Europe to grow even more that we wanted, that I feel now the US is somehow providing for our company. Now, in terms of competition, now obviously in Europe we have one or two competitors, which is great for us. In the US, we have more than that. And I've been very carefully looking at all the competitors. There are very good solutions out there. It's good because a good competition educates the market as well, William. So people in our space, especially asset-based credit, they don't come from substituting a previous technology, but they come from substituting spreadsheets. So you need to educate them with your process, and we need to do it all together, right? The market is very big, and we need to know where to position ourselves and how to offer the best solutions to our clients. And in our case, our positioning is toward offering the best solutions to the buy side, to the GPs, because we feel that's where the biggest complexity is, and offering this solution that can really understand the structures that the buy side is doing and has been doing before, and also benefit from what I told before. So from this data that is sleeping there and not get the advantage that we feel they will have. So the market that we see, as I mentioned in the beginning, is around 20 trillion in terms of assets under management. We would forecast a 1 to 3 bips charge on that market, and do the math where you'd get towards where the technology spend would get to. We have an embedded solution, William. So we are not only selling software, right? We sell software, we sell data, and we sell intelligence, AI, and infrastructure with it.
Right.
So you are a client that can cherry pick what you want, compose your own solution, and we would configure it for you and provide it to you. But last thing on this, one thing that I feel we are very different from what we have seen nowadays in the US market is the data integration and onboarding side. We see that a lot of tech vendors in the US have not been able to produce a very flexible and powerful big data environment, which we, by design, being in Europe, needed to do. So we think this will give our clients a faster time to use our technology, but also a much more flexible way to add new data, integrate the data, play around with the data, do whatever they want in terms of creating apps, but also evolve with it. So the evolution is super important to me, William, because when I was at BlackRock, I wanted to find a solution, and I could find some parts of it, right? I could find a data treatment, data standardization tool, but I couldn't find somebody that was speaking to private credit or asset-based credit positioning. And that, along with the reports that my investors were asking. So I want to be able to give to the market exactly what I was facing 6 years ago.
Well, I'm curious because you mentioned earlier that your asset class agnostic,
Yeah.
right? You want to be able to service the entire market, ABL market, as it's broadly defined. But are you finding either in Europe or I guess in particular in the US that there is demand for one type of asset class more than another, or group of asset classes more than another, where and I would also say that, not all asset classes are equal in terms of complexity either, right? So,
Absolutely.
where is the demand as you see it?
I mean, you are spot on with that question, William, because having a lot of asset classes means that you are a complete solution whereby the clients could have no limits in terms of where they want to invest next. But if I want to make the devil's advocate of myself, did I know that asset managers should invest, for example, in music rights or in legal
Right.
claims or in solar panels? 10 years ago, not really, right? Everybody was talking about, clean energy and everything, but never that we'll have an asset-based credit market that would evolve so fast. So to us, we don't think of technology as something that we need to code in all the characteristics of all the asset classes that are out there. We would be dead by today if we were to
Understood.
do that. We need to have a flexible setup whereby a new asset class that comes tomorrow. So, for example, the NVIDIA chips, right? We have seen some securitizations around securitizing NVIDIA chips, right?
Right.
Now, how do you think about NVIDIA chips? It's an asset that is an equity-like investment with a balloon payment or, let's say, an amortization plan that pays every quarter. But then the asset itself decreases the value very, very frequently. So whoever has securitized those positions need to have an access to a marketplace or to an information that can track down the value of the NVIDIA chips. Now,
Yep.
how do we do that, right? We could search the internet, we could search the NVIDIA database in case they provide it to us, but one very quick and dirty solution would be to scrape the data from eBay marketplace on how the prices of NVIDIA are doing. And we found out that every 6 months or 4 months, this price is going down with at least 2 times. So because of the new chips that are being born, right? The previous ones that you have securitized have lost the value in 6 months,
Yep.
2
Yep.
times more. So what is the risk of the junior investor into that securitization? And what is the risk that the mezzanine investor is looking at, right? So it changes totally on what you thought of 6 months ago. And how do you monitor that in time? How do you get alerted if this value is changing so much? So again, when I started this, I never knew what an NVIDIA chip was, and let alone what would happen in the future. So I feel like we have done this technology in a very flexible way to cope with cases where the structure of the assets are very different. The information that you need to calculate the value of the assets can come from different places. And there are lots of things that we're thinking around the AIT payments, for example, EOT payments, or a card that pays the fuel by itself. Now that will be securitized, and how that will be securitized, how do we get those data in? Those are all things that we think the future will tell us if we are right or wrong. But I think that you need to think about the flexibility to build a really solid solution to go for covering all the asset classes.
Yeah, I don't know. I don't know much about the NVIDIA financing arrangement that you just articulated, but it reminds me of, like, I don't know, an auto lease or rental car arrangement where you really need to have tight systems around the value of the metal on a real time basis, or at least on a monthly basis. So that takes that integration of asset management reporting and valuation along, and marrying that with the liability structure is pretty intense. As
And
far
it's
as
very
these things
different.
go.
Every structure is very different from the other,
Right.
which pays into the creativity of our market, William.
Right. But okay, so we're talking about some complexity here, but you also do the straight down the fairway, plain vanilla asset classes too, I'm assuming.
Absolutely.
Yeah,
I
that
mean,
would be.
that's the biggest part of our technology, right? So we're talking about consumer loans, auto loans, lease
Right.
leasing
Okay.
positions, the small medium enterprises, the solar panels, and yeah, these are the 4 or 5 key ones. Residential mortgages sometimes, yeah. So,
Right. So you're looking for asset managers who are active in those in buying and trading those portfolios, who maybe have outgrown their own proprietary systems, or are looking for a more a next level kind of solution to data management and forecasting, and I guess you said data warehousing as well is another
yes. Yeah, but
another
also,
value add.
William, I mean, we are not in the business of substituting technology, to really be honest, because it's not about you take out what you have done and now Cardo comes in and shows you the way. We know that
Right.
there is a lot of knowledge and intelligence and sweat put in legacy systems that our clients have, and we don't want to substitute them. We want to be able, think of a big puzzle, right? That you want to construct your strategy around the technology that you want to use inside, and you think on what is your best strategy forward. There are firms that say we want to keep all the technology investments and capabilities inside the firm, and that's fine. They're never going to work with us. That's great. We have those firms that say we want to outsource everything. So, hey, Cardo, tell us what we need to do, how we need to play around the big data warehouses yourself, and for example, some data providers that we need to put into the system. And we would help them out. So we would complement with everything they have bought and also fill in the gaps where they have problems. There are cases where, and this is the biggest part, where the GPs or the asset managers come to us and say, we have already some systems in place, our internal ones, but also some external that we have bought, but we are missing some gaps around, for example, aggregating asset-based credit data, around building models on top of those data, around reports to those investors, which is very different from what we have used. And in time, we want to also internalize some of that. But in the meantime, we want to use you guys. And we love that kind of challenge because that's what we are here for. And again, the cool thing is that you don't get stuck with us. So when you want to innovate back, I mean, in the future, you can do so, and we would take out the feature that you want to internalize, and because of the microservice architecture that we have built. So it's a very, I would call, open source / open collaboration technology that helps clients keep on going with what they want to do and not feel like they are stuck with the technology, as I felt when I was in BlackRock, right?
Gotcha. Well, Altin, I know we're getting to time here, and it's been really educational for me. I'm sure for our listeners as well, and hearing your company's story and your personal story as you've grown this company, and now you're at entering a new, let's hope, a very exciting chapter, entering the U.S. market. Did we leave off anything that you want listeners to know about Cardo entering into the U.S. market, or anything else that you just didn't have a chance to talk about yet?
No, I think we covered most of the things, William. I think we went deep into how the technology supports our clients and how we think the U.S. market is different from the European that we have been so far. But also, I feel how many opportunities are in the U.S. market compared to what we have seen so far. And these opportunities play only into the favor of where our clients can get. But also, we mentioned a lot around the new investor types, so the retail investors coming in, but also one other angle that I want to stress out is the insurance clients, institutional investors that come from the insurance market. Those have very specific needs, and with those needs, you need a lot of technology to help them stress test, project the cash flows, understand where the losses could be in order for them to get the confidence on the regulatory side. But most importantly, I think one other, and I think this is the last comment I have, is on where do we see the future getting to in terms of this market? I feel it's a collaborative market. It's not a market that doesn't innovate. In fact, it works very fast. It walks very fast as well with the structures and the new things that are coming. And I feel this is one of the most the most dynamic markets I've ever seen, given the pace of change, but also the structures that I've been seeing. But most importantly, I feel the appetite for looking at how the market will evolve and positioning yourself into that evolution is something that I'm very, very curious to see how that will play out in the US market.
Yeah, I am too. I mean, it is incredible the number of, fintechs, entrepreneurial efforts, however you want to call it, that are in this, not just your space, but in broader defined finance space, fintech and beyond space, and the amount of innovation that's going on. As you mentioned, the amount of competition that's out there that's going to make everybody better. It's been a tough few years with rates being as high as they are for some of these companies to get the financing they need to survive. But they are, it seems to me. And now rates, at least, we'll knock on wood, they're going to be coming back down. Maybe it's going to take longer than people hope, but it seems like they're now on a pretty confident, we can be sure that we're going to be on a downward trajectory for rates. We'll see how low they get. We're probably not going to be back to near zero as we were for so long, but still more favorable environment. And I wish you and everyone at Cardo all the best in entering this market and growing your market in Europe, of course. So thank you, Altin, for spending the time. And it's been a real education, as I said, for me, and I hope for our listeners, very interesting. And again, I wish you all the best of luck.
Thank you so much, William. Thank you as well.
Thank you. Take care.